Hey there, everybody. Welcome back to 21st Century Renaissance, and welcome back to another Open Interest Newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Welcome back to another video that looks like I am broadcasting from a prison cell. But don't worry, GameStop is certainly does not appear to be stuck in a prison cell this week, which is some very excellent confirmation. Happy to see that we are reading some of these signals well. I know, all right, we got some surprises thrown at us, a few curveballs. We're continuing to try to improve and understand our methods for predicting price action in GameStop. Specifically in GameStop, right? I haven't really tried to understand too much else there, but certainly GameStop in context of the broader market as well. Right, a couple curveballs thrown at us. A couple surprises, maybe back mid-January, towards the end of January, but it's nice to see when we can anticipate some of that recovery. Understand what are the key markers throughout the day that are going to tell us whether we're going to see that type of continued price action, which we saw yesterday. So was very happy to see that, certainly on my end, right? You go a little crazy, you're like, oh, I think it's going to happen. It looks like it's going to happen. And then it does. And then you don't feel that crazy. So so certainly some very good things yesterday. So we'll break down some of yesterday's price action. We will also go into today, why I think we are going to see, we certainly are going, right, this is a tricky sentence, but why I think we have some significant chances today to see continued price action, some continued movement to the upside today into Wednesday. But it could be a move that stretches out over the next 2 days, like I drew up yesterday. So we'll revisit some of that as we get into today's video breakdown. So thanks go out today to Super Mega Ultra 7 for sponsoring. I don't know, this has got to be like his 15th video and newsletter. So you are certainly one of the GOATs, Super Mega Ultra. Thank you so much for my coffee today. Thank you for your support. Thank you, as always, to Dat Scruffy. Thank you so much for your support every month on a regular basis. Blessings go out to you and your family, as always. Right, so here at Open Interest Newsletter, right, nothing. Everything is open access. Everything is for free. Everything is accessible to everyone. Nothing is behind a paywall. Nothing is monetized. The policy here is you win, and if you feel like saying thank you, you say thank you later. That's how it goes. So, certainly welcome to everyone who happens to be new to the channel. If this is your first time watching one of the videos here, you'll find that the breakdowns, the articles that I talk about, I post to my X account every day before market open. You can find those linked in the description of this video down to the current article that we're talking about today. And then you can find, of course, early editions going all the way back to last summer. So today, right, let's hop into it. Let's take a look, see what we got here. I want to adjust the camera a little bit, make this bigger for you guys. There we go. We'll do me, small face, thing, article, breakdown, big face. There we go. So one of the key signals that I was looking for yesterday, as far as thinking about whether we were going to see kind of this sort of lame duck recovery that just goes into another period of flatness, or whether we were going to see something that was a bit more dynamic, was definitely the type of volume that we were intending to on the day, and as well as some of our intraday price actions. So yesterday during the day, right after about the first hour and a half of trading, I put this up on my account, on my Twitter, as a post on my X account, right? So what we were looking at was, thought we were going to get this recovery scenario thought we were going to get this recovery scenario at least into this 2650 kind of area, a little bit above. Couple moving averages we were looking at yesterday. I was looking at yesterday that I pointed out, as well as this 2650 area. So, right, you'll remember a few weeks ago, really through this prior consolidation phase. So last 2 weeks of January, basically after that dip we had on the 14th and the 15th, but last couple weeks of January, we had really looked like one trader. I even wonder if it was the same trader, basically coming in and selling a lot of short puts at 26.50. This in particular is very interesting, right? Because when we talk about dealer gamma hedging dynamics, so options market makers, how they go ahead and hedge the positions, right? Hedge the options trades that they facilitate through their responsibilities as market makers, is they go ahead and they hedge based on the delta value that they take onto their books by selling those contracts, right? So delta measures the change in value of an options contract per dollar change of the underlying. So if an options market maker has, even equities market makers, because you can, right, the underlying share is considered a one delta product. Right, it's always has a delta of one. So for every dollar change in the underlying changes by $1, right? A little circular, but you get the point. Right, so equities market makers too, they're going to use this kind of hedging principle as well, but they hedge delta. And then they hedge derivatives of delta in order to better and more accurately and more dynamically hedge their delta value. So they have negative delta values on their books. They're going to hedge that negative delta by buying shares of an appropriate number to match the delta value on their books. If they have positive delta on their books, they're going to match that by selling shares. Okay, so as delta goes up on their books, they're going to hedge that by selling more shares. As delta goes down on their books, they're going to hedge that by buying more shares. In the case of a short put position, I should say a trader short put position, that's going to put negative delta on the dealer's books, and it's going to require that dealers hedge that position by buying shares as that put moves into the money. So what's going to happen there is that strike, as it is approached, in terms of gamma hedging, gamma, of course, measuring the change in delta, the rate of change of delta per dollar change in the underlying, right? As strikes are approached, as an options contract is about to move into the money, its gamma value spikes. Or I should say, just into or just out of the money. So right when it is in the money, its gamma value is highest. So usually when we're thinking about gamma distributions, we're thinking about how data from big sites is typically presented to, how it is typically packaged as a data product. It's usually separated into call gamma and put gamma. Put gamma and call gamma being the operative terms, because it is assumed, and this is largely true on, say, indices like SPY or QQQ or SPX, traders are typically buying in very large quantities. They're buying short-dated single leg options contracts that are almost always long. The vast majority of these contracts are long, and so you can treat put gamma as negative on traders' books and therefore positive on dealers' books. And you can treat call gamma as almost always, as usually, long on traders' books. That means positive on traders' books and negative on dealers' books. And then you can, make your inferences. Oh, I'm scratching the mic there. You can make your inferences about how the dealer is going to hedge those positions accordingly when you operate under those assumptions. However, right, that is a broad assumption that is usually true and effective as an as if. So in the context of dealing, say, with SPY, that's a pretty useful assumption you're going to make as far as trying to anticipate dealer hedging behavior and how that's going to affect the price at intraday levels. Not so much on equities, right? So something like GameStop, which tends to be very call skewed anyway, at very highly traded strikes, at very liquid strikes, something like 30 or 25, it is generally, you can assume, right? It's a good policy to assume that you're going to have an excess of long calls. That's going to primarily be trader long calls and dealer short calls at those positions, just based on how traders happen to approach GameStop, especially retail traders, right? You get a big euphoria moment. Everybody goes, oh, it's going to go, it's going to the moon now. Time to leap into calls. You see that a lot, right? However, certain oddball strikes like 26.50, which is not a very commonly traded strike, you can see in the data when the actual flow and trade of options contracts at these oddball strikes. You can isolate when you have atypical behavior or something that would go against what you would expect just from the sort of face value call gamma, put gamma that gets presented to you. So 2650, right? We noticed the trader had come in for several weeks and had, whether it was the same trader or whether it was different traders, somebody for many weeks, the last 2 weeks of January and then heading into even February, was selling calls at 2650 in pretty decent numbers, right? Thousands of contracts at a clip. And at the very beginning of February, or I should say, maybe this was going into January. I think this was going into, I forget specifically whether this OI opened up going into January 31st or whether it was coming into February 4th. But a trader did go ahead. Actually, I think it may have been into February 4th. But in any case, a trader did go ahead and open up a fair number. It was around 25 to 2,800 short puts at 2650. Yeah, I think it was actually prior to this. So in any case, I'll stop speculating. A trader did go ahead and open a fair number of short puts at 2650, which coming out of the Monday dip on February 3rd, that level acted as a resistance, largely because of the effect of the short puts. We didn't have enough volume. We didn't have a strong enough recovery at that point under that 2440 kind of hole in the pre-market and in the overnight exto period. And so that acted as an intraday resistance, and then we deflected to the downside and then kind of had this sort of lame duck recovery into the rest of the week and traded back down almost to that Monday overnight exto low. What we saw today, right, or yesterday's trading, was the continued presence of that 2650 put position, which of course, as we pointed out yesterday, you go and you look at the gamma chart, that put position looks like it's going to be slippery. Not so. We moved up in there, right? See, you can kind of see this kind of sticky dynamic, right, where we kind of get up there, right? It shoots up, and then all of a sudden, boop, we do a little bounce, right? And of course, we had some technical levels up here. We had the resistance line of our bearish regression channel was up there. We had, I want to say this is the 54-hour moving average was in this area. And then we just kind of scrubbed, right? Like this kind of stickiness, right? We got to this level and then just kind of scrubbed around for a while. And basically what that told me was, okay, yeah, we went ahead and read the gamma correctly. And you know, what seemed like an obvious trade to me was, okay, you get this big ramp up here. What do traders typically go and do when they see this, right? They draw on a bunch of institutions who drive this kind of gamma volatility squeeze through this area here. Ended up, right, pumping IV, as we can see, to levels we haven't seen in about 3 weeks, I would say, maybe a little bit more. And then what we got was then a pretty steady flow of short calls from the market. However, despite this, it did not quite meet, if we scroll down a bit, right, did not quite meet, did not quite sort of cancel out the bullish volume on the way up there. So we had a kind of quieter move down, bounced off of VWAP, bounced off of a good technical level, and then moved up, and then looks like we moved into some sort of bigger accumulation pattern. I'm not sure to the extent to which this was actually options driven, although certainly this did attract a lot of options volume. Maybe this move, I think up to 27 may have been a bit more, this looked like something that was options driven. This looked like some day trade type stuff, but then very interesting to see us really pump pretty hard into the close there. So certainly we crossed the sort of volume thresholds I was looking for. I said, look, hey, you know, we come in, we get something like, you know, 5 million, 5.5 million, like we've seen, even though it's kind of a tick up. Maybe we go up to that 2650 level, but then we just kind of cool off for the rest of the day. However, yesterday, of course, you can go back, you can check out the video. I said, hey, if we're getting something like 8, 9 million, pushing that 9 million number, I think we can, you know, work our way up above into that kind of 27-ish area and maybe go a bit farther. So We got over 9.5 million total volume on the day. Certainly looked like it was going that way by about midday when we got the second push towards 27. When I saw that, that said, okay, first scenario done, played itself out. There were, some intraday trades, right? These volatility trades, these short volatility trades as IV was on its way down. And you'll notice too, right? IV actually tapered off throughout the day. So many of the short call trades, like, let's say not all of them, but many of them that were entered into here, even though the price was higher up here at 27, basically all throughout here were still, many of them were still profitable just based on kind of the difference in IV up over, like 83% and then kind of back to 77, even down here. But then this last pump started to, depending on what strike you were looking at, started to kind of play with that a bit. So we are trading down a little bit early. Not sure. I mean, this does make sense kind of, looking at some of our other charts, the 15-minute chart, 30-minute chart, looking at something like the 4-hour chart does appropriately look like something of a cool off, a little bit. I would say on our longer term charts, looking at say the daily chart, if we go down to our technicals a bit, we are, yeah, I mean, it still does look like we have a bit of room to run. We can see we found resistance here at around the 20-day moving average. But it does look like, we have a couple key levels that are kind of coincident. We have this 2880 or 85 level that goes back basically into, basically into our run, our 4-hour chart actually, but goes back into our November run as one of our resistance levels on kind of one of the first big up moves before we kind of got this small correction in and around November OPEX. So we have that historic level, we have the 50-day moving average, and we have also the 204-hour moving average. And those, if we go over, so you can see this line here a little bit more clearly, we can see that all three of those levels, that historic resistance level and these two technical levels, these moving averages, are all coinciding with one another. We also use the 50-day moving average on that 2-week period, that 2-week consolidatory period back in late January, right? So on Roaring Kitties, the day that Roaring Kitty posted, this would have been at 8 p.m. Eastern time, the Wednesday of that week following January OPEX. So that was, I think that would have been the 22nd of January. So what we saw there was using the 50-day moving average as a resistance point. So what that says to me is that there's a high likelihood that if we do get some continued upside, which I think is a distinct possibility, that we would top out in that kind of 2880 range, kind of just shy of $29, based on the confluence of all those marks. RSI on our daily chart, so really hasn't hit neutral yet. So RSI neutral is about 50. We've been doing full channel reverses. Not quite. We did kind of consolidate around RSI neutral, right? Slightly below RSI neutral in this previous consolidation channel. So I'm not sure the extent to which we would use that as a resistance. I can't find any easy arguments to be made for that serving as a resistance, having almost touched oversold here on the price action at the end of last week. I wouldn't necessarily assume that we would make it all the way back to overbought territory, but I could see us moving certainly a decent amount above neutral into maybe around 60, maybe not as high as 65, but that I think probably around 60 or 61, something like that, should be the RSI value we see if we do go ahead and test. If we do go ahead and test that kind of 2880 area. Of course, that will depend on how fast that ascent goes, if it takes place over 1 day or 2 days. I think a 2-day a 2-day up move into that level is possible. I wouldn't necessarily expect that this would unfold as quickly as it did today. So it might take about 2 days to unfold. But basically, RSI is saying we've got some room to run, and that does make that kind of triple coincidence of historical resistance level. And then the 50-day and the 204-hour moving average all kind of sitting at the same level definitely makes for a very tantalizing upside target. As I pointed out yesterday, you can go back and check out yesterday's post and check out those charts there. In terms of our context in SPY, which I breezed past in order to get to our sort of recap yesterday. Yeah, we mostly stuck to within this neutral bracket that I pointed out, which doesn't seem to, right? We didn't activate, we didn't cross the volatility trigger, right? We sort of stayed above the gamma flip line, didn't move down to right 600 is where our volatility trigger was. But at the same time, we didn't quite move up into that really stable super gamma, call gamma dominant position. That seems to have been okay, right? We slid up and down a couple times that neutral range, but by and large, this didn't seem to cause any issues with respect to what ended up unfolding in GameStop. So no gamma data today. For some reason, Unusual Whales not able to supply me with that. Not coming up on any of my charts. Not coming up different browsers. Spent some time fiddling around trying to get that data today. So kind of working on hunches. Kind of not exactly shooting in the dark, but I don't have those numbers heading into today to be able to provide the most accurate idea for what we're looking at in terms of what our key levels in SPY will be for today. What is that going to look like then? Where are we trading right now? In the 602, yeah, maybe we make a run towards the volatility trigger. Hard to say. I mean, yesterday, right, it was at 600. So I guess basically my working level in there is gonna be to assume that it's probably still around 600, that it hasn't changed too much within a day. I mean, GME is a little tricky because it really acquired, as we'll see in a second, a lot of new OI. But SPY, I don't think that's probably going to change as much. So yesterday, right, volatility trigger was at 600, gamma flip line 601, 602. So probably something close to there. We're trading at around 602 pre-market, about a half hour before market open right now. So keep an eye on that, right? If we do head into that 600 level, we could slip on down pretty fast. Bearish options flow probably going to pick up, and that may raise some questions as far as what we see in the recovery today. So good to keep an eye on what SPY is doing there. If we see a decent sized rundown, like if we run down to 595, or if we run through 595 back to that kind of 590, 591 area, like we saw the past couple weeks is kind of a low, then yeah, maybe GME gets pulled down a little bit. Maybe the continuity of this recovery doesn't really play out to the extent that we might otherwise expect in stable conditions. So not guaranteed that we're going to lose stability in SPY, but it's teetering. We've been teetering for a while, not being super committal. Always important to continue to keep an eye there as far as gauging the probability that something like this ends up unfolding. Our options data, yeah, I mean, yeah, we got a lot of new contracts to say the least. Let's see. I just kind of gave you guys a brief rundown in today's newsletter about sort of what we're looking at. 23s short. I don't know to what extent we're gonna. I should say puts. 23 puts were short. So I mean, if we get down there, I guess it's going to give us some hedging support. But I'm not necessarily sure we would ever see that. We're going to see that anytime soon. Hey, anything can happen, right? Anything goes, anything's possible, but not certainly something I'm anticipating popping up in today's trading, to say the least. The 25 fives were trader long, so I guess we can expect that to kind of negatize a bit, be a bit slippery if we do see 25-5 again. The 26s were long in terms of calls. 2650s were mixed, 27s mixed, 2750s long, right? And then we had a lot of long calls. So basically, all the way up on the call side of things, we were looking at quite a lot of quite a lot of long OI, long shifted OI. So mostly trades at the ask. So that is going to give to this character, right? Again, I don't have the gamma data put out in front of me by Unusual Whale, so this is me sort of knowing what I know about how these work without actually doing the calculations. We're looking at some pretty stable territory up above us. We are, again, sort of teetering. Well, again, the 2650s are deceptively supportive. So we are in supportive territory. We are in, maybe 27 is a little bit more neutral. I remember a few weeks back, $27 was a pretty sort of neutral strike, could go either way. 2650 being deceptively supportive. 26, we had a lot, we had a lot long calls there. We still have the short puts at 2650. So we've got some downside support there. And then, of course, as we move up, 2750 is going to be supportive. Well, resistant as we approach it, supportive as we move beyond it. Right, it produces the same kind of like grind up kind of condition when we're in that that stable call gamma dominant structure, hedging structure. So yeah, and it looks really like we've kind of got that all the way, even up over 30, right? Some people getting pretty excited about what's going on. So good luck, right? Of course, none of talking about our options data is certainly always important to remind you guys and remind myself, right? Remind everybody watching and listening that this is not an exhortation to go and trade options. There is a lot that looking at our options data can tell us about what is going to happen, or what is likely to happen, I should say, the probabilities that are more likely and less likely as they stand before us when thinking about our price action coming up when trying to forecast GameStop's price. Some interesting stuff for next week. We did get some trades there as well. These are more so on the short side. So basically what this is telling me is trader sentiment up front, super bullish, right? Yesterday's options activity, super bullish. That was pretty bullish. But kind of coming out of this week, not so much, right? Not overtly bearish, but basically what we got was a concentration of quite a lot of I suppose what we would expect, which would be short calls, right? Not super bullish, not hyper bullish. A lot of short calls, a lot of kind of mixed trades, stuff at the bid, stuff at the ask. Not seeing too much in the way of long puts. Right, it's not crazy bearish, but again, it doesn't look like traders looking out into next week are say on the same page as far as the bullishness that we're seeing in the very short term. Another interesting thing, right, was our OI at 21. I didn't even realize that, almost 3,500, I should say 2,500 calls had accumulated at that strike, right? So one trader cashed out 1,187 calls at the bid, right? So this is somebody who had these at the ask and decided that yesterday's move was enough to take profits on and cut the OI at that strike in half. So, this is going into next week, right? My point of mentioning this is going into next week. Traders right now are still a bit more measured. So if we do see this recovery scenario emerge, if we do see this movement, say up into the 28 or 2880 area, if we kind of hang out, maybe, right? If the setup is not there, if the conditions are not there in the broader market, we could. It is likely that those gains maybe sold back off, right, back to the downside, and certainly in the short term, what we see, right, if we look at Max Pain hasn't changed, still around $26. We have closed over Max Pain before, especially in our bull trend back in November and December, but good to keep this in mind. things look good, right? We have a strong chance to kind of punch up and continue our upward momentum into today and perhaps Wednesday's trading, looking at 2880 as an overhead target, but some likely resistance there. And at the same time, there is still a lot of time ahead of us heading into March OPEX. I wouldn't be surprised if, right, thinking about what our IV has looked like, that part of this is driven up in order to stimulate the type of options activity that we are seeing. I think, as I've talked about, heading, I mentioned this several times over the past couple of weeks. Basically, what I was expecting was, heading into, and I said this multiple times, heading into institutional filings, which we are this week. We could see some bit of a kind of a hitchback in our IV, as we've seen here, right? So an event that kind of drums up interest, drums up some volatility, but is not a real full recovery to the bullish conditions that we were seeing in November, December, and early January. That this would take place, getting close to 52-week IV lows, so that market makers can drum up interest, they can draw in buyers, they can sell those buyers higher priced, right, higher premium, right, drum up premium values. They can sell calls to excited and excitable, euphoric options traders, especially retail traders who love to bet on single leg, low probability, way out of the money, short expiry long calls, which fail at an astronomically high rate. They are structured in favor of the dealer. To drum this up on the thought of, oh, hey, we're really going to pump back to the upside. We're going to go right back to 30 or 35 or whatever in a couple weeks, only then to, surprise, coming out of the institutional filing season, get the stock maybe shorted down again, and we're kind of back at around 25 or 24.50, kind of heading into February OPEX, right? Wouldn't that suck, right? But that's the sort of thing. Not necessarily saying that has to happen, but that's the sort of thing I've come to expect at this point from the options market making game. And especially with so much time between us now still and Q4 earnings. So that's not to say that we'd have to wait that whole length of time before we get some more activity, but I'm not expecting things to kind of stick to exit really fully our consolidation phase until we kind of get into that 2-week IV appreciation prior to earnings, which should begin sometime around March 11th, March 12th, as I've talked about. So still basically conforming to our pattern of price action, our model of price action, of course, within a range of precision, right? Of course, I admit, right, I don't have unlimited precision with these things, but, largely conforming to the archetypes that I have been able to take a look at here, both for trying to understand what's going on and to guide my own investment in trading. So I hope this is helpful for you guys. I look forward to seeing what goes on today. I'm certainly very hopeful in terms of what we can expect. I'd certainly love to see some continued upward price action, some continued recovery. So of course, be careful out there with your trades, right? Stay cautious. I certainly am, despite the fact that this is not trade advice, right? Always exercise caution in everything we do here for educational and entertainment purposes only. So thank you so much, as always, for watching and listening. Please let me know you have questions, comments, concerns, anything otherwise. Let me know down in the comments. Always great to hear from you guys. And good luck out there, and we'll catch you tomorrow. Take care now.